So let's go ahead and continue with the last lecture, lecture number 1. I'm talking about our balance sheet, which is another name for a net worth statement. And as you can see, it's a little small here, so increase your view or look closer. But you can see we're working off of worksheet 2-1 and that there's 2 basic columns of data. And I just want to kind of unpack this a little bit based upon what we just talked about earlier in the first lecture. So on the left-hand side is a column called assets. And on the right-hand side is a column called liabilities and net worth. And you can see that the assets have got a number of subheadings which correspond to a prior slide that we looked at in lecture 1. And that first section is called liquid assets. And again, those are all the items that I have that are either cash or very cash-like. So this person has $70 of cash on hand, $150 in his or her checking account, and a money market fund of $650. And then you can see there's a subcategory or a subtotal called total liquid assets. And under investments, some stocks, some bonds, and then again, coming down subtotal, total investments of $3,500. And you can see how they've lined out the different columns in Excel. And when you prepare your balance sheet, I'd like you to do the same. Third, real property, they have a primary residence, $68,000, and some personal property, cars, household furnishings, other. When you do yours, I would encourage you, anything that you don't have a balance in, don't even enter that in. So under personal property, it said recreational vehicles, they don't have one, you wouldn't even have that subheading in there. And then total assets all the way at the bottom, total up the liquid assets, the investment, the real property, and the personal property. And then in the right-hand column, you can see current liabilities, what's due or what's coming due in the next 12 months, utilities, insurance premium, taxes, etc. And long-term liabilities, they've got a mortgage on their home, an auto loan, and an appliance loan. So their long-term liabilities are $55,500. And again, the difference between what you own, your assets of $84,095, and your liabilities, what you owe, $56,800, the difference is your net worth, $27,295. So this is on page 48. This is exactly the model that you will use to create your own balance sheet. So the assets is on your balance sheet should be the fair market value. In other words, what do you think you can sell an asset for? What's the market value? If you put your car for sale right now, maybe you paid $20,000 for it, but it's worth $8,500 right now. So just be aware, if you're an accounting student, that's different from generally accepted accounting principles or GAAP. And liability, everything in the current is the amount you owe within a year. Long-term is the amount that you owe more than 1 year from the date. Couple terms for you to be aware of. Solvency, you are solvent when you have a positive net worth, and you are classified as insolvent when your net worth is negative. But again, not to despair, if you're a student, you probably are insolvent because you don't have any assets and you may have significant student loan debt. So there's hope yet. You can see over here on the y-axis is the median net worth, and over here is the your age on the x-axis. And you can see obviously your net worth increases over your life. This data, I believe, is from 2015 or 16, and then of course decreases as you move into retirement. So an income statement is another financial statement. It's basically what you earn and where it goes. So what do you bring into your home and what do you spend it on? And personal income statements are prepared using cash in and cash out. Again, this is different from generally accepted accounting principles. You're in a surplus situation if you have more income than you have expenses. And your income is everything from interest on your bank account to your proceeds. You know, you sold an asset, you sold your ATV for $2,000, that's income. Obviously your wages, your tips, anything like that. And expenses is everything that you spend, your taxes, your debt payments, purchasing assets, your rent, your utilities, your cell phone bill, etc. And as we move into worksheet 2.2, which is a little bit down the road, and I'm just showing you the different types of categories. Again, you're only going to place into your income statement those items that pertain to your situation. This is a pie chart that just shows on the average, again, the state is probably 4 years old at this point, the percentage that on median that we expend on different categories of our income. Healthcare 7%, housing 34%, etc. You can see this. So we're not going to spend as much time on the income statement as we are on the balance sheet and a cash budget. And a cash budget is incredibly important because for most of us, that really represents what comes into our home, and we forecast into the future, budget into the future, what we think we're going to have coming in and what we think we're going to have going out. And it allows us to look at a particular point in time, say in the next 12 months, which is how we're going to prepare a cash budget, in which you may have a deficit. In other words, you're not going to be bringing in as much money as you have going out. So, you know, for example, for a student, it would be probably in August and January when you have book expenditures, or you have the deposit on a new apartment in August. And then secondly, in months where maybe we have a surplus, so for example, we have student loans coming in, or if you're working, you get a bonus or a tax return, you may have a surplus. And the key here is, what do we do with the surplus? We don't just want it to sort of disappear into the maw of our budget. We want to plan for it. We want to maybe put money into an IRA or pay down debt. So that's what we're going to be doing with a cash budget. So in the months that you have a budget deficit, it's critical that you understand how you're going to get through that. If you've got savings or investments or an opportunity to sell some assets or use some credit, then that would be your potential options to meet your shortfalls that month. And also maybe cutting some expenses, pulling in a second job, getting a roommate, whatever it would take to increase income to meet those deficits. But you can't do a cash budget and recognize that you're chronically going to have $500 in deficit a month, because clearly you've got to have a way to meet that deficit. So again, bear with me, this is pretty small text, but I just want you to take a look at the overview here. So this is a 12-month cash budget, and we're going to be preparing one of these this chapter. There's 13 column headings, January through December, and then total. And this person has got some different items of income. Wages, pulling some money over from savings, which he or she's going to need to do to meet their deficits. Student loans, they get a birthday gift in March, and then we've got a column or a row called total, which shows the total income per month. And then expenses, and I encourage each of you to have your very first line item be savings, even if it's only $10 or 2%, whatever. That you do recognize that you've got to be funding some sort of a savings instrument every month. Rent, food, tuition, you can read down here all the different items. I highlighted in green the bottom 3 rows there that are items that only happen a couple times a year, like car insurance comes due twice a year, or Christmas expenditures, moving to a summer job in May. But the key here is that this has been prepared to manipulate the budget so that the bottom row, surplus or deficit, is basically break even. And that goes back to 2 slides prior. When you just plug in your basic numbers and you see a surplus, it's like, well, what am I going to do with that? Am I going to increase my savings that month? Am I going to add a row that says pay down debt? Or what am I going to do with that surplus? Conversely, in the months where you have a deficit, so this person obviously in April, May, June, August, you can see all those months on the row called pull from savings. She's needed to pull money from her savings, which I assume she's built up from her student loans, in order to balance her budget for that month. So in bright red at the bottom, obviously you need to work with this to handle your deficits or your surpluses. What are the choices? Concrete steps. How do I make my budget work? So we've got the spreadsheet, there's a bunch of numbers on it, now what? So there's different ways to, again, work on cohesively saving, and that is to set up an automatic transfer. And I really recommend that everybody does this, that in addition to just your checking account, that you have a savings account that will pull, particularly even if you've got a very part-time job or a full-time job, whatever, that you pull on a monthly basis $50 into your emergency fund, or $100 into your IRA, or $75 to a car fund if you're saving for a car. So it's really, really important that you build those line items right into your budget, because a lot of people will just have that be like, if I have money left over, I'll save. But that's actually not really a plan. Behavioral changes. How do I affect behavioral changes? So when we do our cash budget and make our budget, it's super important that you check in with it once a month. How did I do? Do I have have I met my expenses and funded my savings like I planned? Or did I pull from my savings to cover my deficit? Am I sticking with my budget? And for many of us, that's not always possible because the battery goes out in your car, or a roommate leaves and you get stuck with a Northwest Energy bill, whatever. But you should be able to explain to yourself and to your spreadsheet, or to your partner if you've got one, that you're sharing finances with, why you didn't make your budget balance. So spending cash, it is important to have a credit card. We'll talk about that, I think, in chapter 6 and 7, about the importance of having a credit card and building a credit score and a FICO score, which is a credit number, and how to use it appropriately to help ensure a solid financial future. This is, the last bullet is just sort of a rule of thumb, and I really like this. I can't say that I'd seen it before I taught this class, but before you buy, they advise you to take a look at big purchases. So, and everybody will set a number that makes it a big purchase for themselves. It might be $100, it might be $500 for a family, it might be $1,000, whatever. It might be $75 in your household. But if you've classified it as a big purchase, that you give it 2 days before you make that purchase. So I'm in Costco trying to get a great deal on tomato juice and vitamins, and I see some lawn chairs that I really want for my backyard. That qualifies as a big purchase in my family. I don't buy them. I walk out of Costco. I think about it for a couple days. And if it still feels like something that I can do and I've consulted my budget, okay, that's great. But I've given it that 48 hours. And secondly, on small purchases, the impromptu ones, so I'm at Costco for the tomato juice and the vitamins, and there's a beautiful bouquet of flowers for $15. Okay, great, that's a small purchase, and they're beautiful, and I can picture them on my table, but I give myself 90 seconds. I walk away from the flowers, I think about it. I'm not saying I don't ever get them, but it's just putting a little bit of a pause on that purchase. So I thought that was great advice. So conversely, if you're in a situation where you've got a surplus, that's great. What am I doing with a budget surplus? I'm increasing my savings. I'm increasing my payments on my debt, whether it's credit cards or student loans or car payments or a mortgage. I'm setting up a savings account for large ticket purchases. In our family, we have a separate savings account that we put some money in every month into to save for our next car. We don't have any immediate need for another car, but probably within the next 3, 5, 7 years, we'll need another car. And rather than starting from ground up, put away a couple $100 a month or $80 a month, whatever you can do. And when you get there, you've got a little bit of cushion to help you move into that large ticket purchase. And then just to recognize the term variance, every month it's important to compare what I was just alluding to earlier, the difference between what you brought in and what you spent. And that amount is called the variance. And if you take a peek at page 68, they've got a variance analysis there on worksheet 2-4 that just goes down and shows item by item how much either the revenue or the expense was over, under what they had budgeted. And that's a little bit more depth than we're going to get into, but it's a great way to analyze how you're doing. And with that, I'm going to leave off on this slide, and I will have the third lecture will be on the time value of money, and we will actually work out of the book together. So it's important with that lecture that you've got your book in front of you, because we're going to be using some tables from the book. So with that, hope that this has been a worthwhile lecture.